Why trade with structured products? Because structured products offer something traditional investments often cannot: higher potential value. That could mean enhanced returns, added protection, or a payoff tailored to your risk profile. Outcomes that are difficult to achieve with plain equities or bonds. The trade-off is greater complexity and sometimes higher risk. For many investors, structured products can seem difficult to understand at first glance. But the truth is, every structured product is built from three essential blocks that work together: the underlying, the derivatives that shape the exposure, and the payoff. Once you understand these three blocks, the entire structured product universe becomes much easier to navigate. The first block is the underlying, or simply the market or asset the structure is built on. For example, equities, fixed income, currencies, or commodities. It sets the theme, the market behavior being referenced, and the broad direction of the idea. This is the starting point for any structured product. The second block comprises the derivatives, the tools that define how you take exposure to that underlying. Think of derivatives as levers you can pull to shape an investment. Adjust participation, add protection, boost income, or target specific market conditions. The main tools here are options, forwards, and swaps. This is also where market forces come in. Interest rates, dividends, and volatility all influence how these tools behave. Volatility in particular is not just a market condition. It is a core pricing ingredient, and when used effectively, it can create opportunity. Higher volatility can support higher coupons, deeper protection, or stronger participation. Lower volatility typically leads to more conservative features, such as more cost-efficient hedging. Ultimately, this block is what gives structured products their flexibility. By combining these tools in different ways, you can tailor the investment to different goals, risk levels, and market views, which is what makes structured products so customizable and useful. The third block is the payoff, the final pattern of returns created when the underlying and derivative tools come together. Structured products may look diverse, but they all stem from four fundamental payoff families, with each one shaping a different kind of outcome. Capital protection, aiming for capital repayment while providing market exposure. Yield enhancement, earning income in exchange for defined downside risk. Participation, accessing upside with controlled downside. And leverage, amplifying both upside and downside returns and risks. Understanding these four families helps you quickly identify what any structure is designed to do. Together, these three blocks form a clear blueprint for understanding structured products. They work together to determine how the structure behaves in different market conditions, its risk-return characteristics, and how well it aligns with specific investment objectives. Like all investments, structured products carry risks, and their returns depend on market conditions and the structure's terms. By understanding how they work, you can better assess their suitability and decide where they might fit within your portfolio.